The Fed Symposium in Jackson Hole, always a big focus for investors. Let's bring in Sebastien Page, head of global multi-asset and chief investment officer of Rowe Price, where he oversees nearly $500 billion in assets for the firm. How has your view, Sebastien, and thanks for being here, you're on set with us, how has your view changed at all with what we've seen the past 6 months? We all talk about what happened a month ago. The whole soft landing narrative was a little bit less certain, I think, but now we're back fine, and the Fed gets an A for how it's handled this?
Hasn't changed much. I don't think we're getting a recession over the next 12 months. I think for Jackson Hole, Powell's going to want to be boring. He does not want to rock the boat here. The markets are on a knife's edge with every data point. And you saw what happened with the Bank of Japan, like a mini earthquake. So that's what Powell wants to avoid. One thing he said at the last press conference got my attention, and it speaks to how the market is behaving right now. He went out of his way to say, we're data dependent, but we're not data point dependent. And so I think as investors, we have to move away from just being on this knife's edge where every single data point moves markets. It's not really healthy, especially with valuations that high.
So at one point, the market thought we'd get, I don't know, almost 200 basis points probably. Then we got down to maybe 50, 75. Where are we right now, and what's the right level?
Yeah, so we're down to 3 cuts before the end of the year, 75 basis points. That's roughly what's priced in.
And will that continue next year? How many next year?
It probably continues. You know, this is important. It's a potential regime shift for investors. We're getting into a Fed cutting cycle. What does it mean historically for markets? I just ran a study of 12 cutting cycles spanning 70 years. Now, I have to say, this environment is a little bit different because usually the Fed cuts when things get bad and worse than they are right now. The Fed wants to cut right now just because real rates, you know, the rate after the inflation is getting high. But again, we don't see a recession. All that being said, 12 Fed cutting cycles, bonds outperform cash 12 out of 12 by an average of 8%. So with this regime shift, I think one of the things we're looking at as investors is, all this cash on the sidelines, is it time to start moving some of it into at least a diversified bond portfolio? Really?
And what would that look like in terms of duration? What would be the best place to be, do you think? Or everywhere?
Right now we're actually short duration. But I think a diversified bond portfolio, we're looking at to reduce that underweight duration. So I'll tell you how we're positioned right now and what we're looking at. We're positioned with a cash buffer and some credit because we don't expect a recession. Where we're potentially moving, especially if rates come back up, maybe a last hurrah for the 10-year in the 4.5%, 5% range, that would be a good point, a good entry point if you want to be tactical, to diversify the portfolio, extend the duration, go closer to a broadly diversified, say, Barclays aggregate index duration. I think that's an opportunity because, rates are higher. And here's another thing, Joe. Bonds, as you've seen over the last few weeks, have started to diversify stocks again. And I've done a lot of work on the stock-bond correlation. It's a bit of a wonky thing, right? But as markets start to worry less about inflation and more about growth scares and the risk of a recession, whatever the probability is, maybe 20, 25%, as markets start to focus on growth risk, bonds can diversify stocks again.
You said that in previous cycles that we've seen, bonds outperform cash by 8%.
By a lot, yeah.
Okay. How much do stocks outperform cash or bonds?
Yeah, so that's a great question. Like, the Fed usually starts cutting when things are pretty bad for the economy. So the equity risk premium, the amount by which stocks beat bonds, is quite compressed. It's down to 2.2% historically across these 12 cutting cycles. But I would differentiate this upcoming cutting cycle in that this is not really a growth scare. I mean, we're on a knife's edge, and things could change. But this is not as bad a situation, and I don't expect a recession. So ultimately, this is a bit boring, but we're at neutral, fully invested between your stocks and your bonds. Stay close to your long-term risk tolerance. That's how I think you play this market. We are long the broadening, though, Joe. I think this level of concentration, if I look out 12 months, it's bound to broaden. Value stocks have quietly outperformed growth stocks by 8% since July 10th.
Well, it doesn't sound like you'd be an 80-20. It sounds like you would favor bonds equal to stocks. Oh, just no, you don't like cash, but so a higher percentage of bonds than normally.
I think
longer duration.
I think as we get into that cutting cycle.
Get into it, go 10-year in stocks and bonds.
Yeah, and there's two ways to take some of that cash and move it to diversified bonds as we get into this cutting cycle. One is to say, I'm not going to be tactical. I'm just going to phase in a little bit of cash into diversified bonds as we go along, so it won't be as sensitive to the entry point. Right. The other one is to say, I'm going to be a bit more tactical. The 10-year's been on a range. The election's coming. We could get a commodity shock with geopolitics. Maybe the 10-year goes back up, and that's a good entry point if you want to play it more tactically.
Okay, great. Sebastien, you want to ask him, is the market saying anything about who's going to win?
We've been asking that question, so it's a worthy one. Is the market saying anything about who's going to win in November?
I think there's so many factors driving markets. I mean, you hear things about positioning, right? The yen carry trade. You hear things about, yes, the Trump trade, but I don't think the market really has made up its mind about what the Trump trade might be. The policies are still unclear. Sometimes they look close to each other. Sometimes they don't. I talked to our Washington analyst yesterday, and I said, tell me how you price in a Democrat versus a Republican.
See, you were asking the question. You didn't want us to ask it.
I knew you were going to ask. I asked our Washington analyst who lives there and lives and breathes this, and he was pretty hesitant.
He doesn't know what's going on either.
Yeah,
okay.
and so
well, that's all good to know.
He said
super tight. Yep. It's a super tight race. That's what it is.
And so I think it's hard for markets to price this. Right.